Hi, everyone. Welcome to the Babylon Theater. Are you ready to rumble? That's better. Thank you. So the term sheet battle is a boxing event around a term sheet. You should have received it and done your homework. We'll see if you're ready. So we ran the first event in Europe in Copenhagen in 2011. And Brad has run about 10 since, and many more in the US before. The spirit of the event is really about opening the doors to what usually is a very closed process. If you're an entrepreneur, you're lucky if you get to negotiate a term sheet with a VC once, twice, maybe 3 times. The thing is, the guy on the other side has done it dozens of times, if not hundreds. And what we wanted is to balance the power and equip you guys, most of whom are entrepreneurs, so that you've seen this and you don't come in and get shocked at actually how complicated negotiating a term sheet can be. So I just want to thank our sponsor, Liberty Global. Are they here? Anybody here? Yeah. Thank you, gentlemen, for the support, making this possible. We can get this beautiful venue. So Liberty Global does digital TV, broadband, VoIP, telephony, and are hitting Europe hard. Is that right? Good. So I want to introduce our players and just get out of the way. So I think you know the premise, most of you. This is obviously a real VC, a real entrepreneur, a real lawyer negotiating a fake term sheet. And the term sheet is quite funny. And you'll hear more about it. So our first in the blue corner, we have our investor, and we're going to give him a big round of applause when I bring him up. So Christian is the co-founder and one of the managing partners of Earlybird. Earlybird has 600 million euro in under management, and actually Christian whispered that they're about to close a new fund, which is awesome news for Berlin, for Germany, for Europe. I mean, more dry powder in the system. And yeah, let's give him a hand. Here he is, Christian Nagel. In the red corner, we have our entrepreneur, Narain Sham. So Narain is the CEO and co-founder of Go Europe. They just launched last week, raised, can I say how much? Yeah, 4 million euro. So Narain is a Harvard Business School graduate and also has a financial background. And so I think Christian will have a worthy opponent. Here he is, Narain. In the supporting role, in the blue corner, in the red corner, supporting Narain, is Matthias Birkholz. Matthias is a co-founder of Linden Partners, one of the more respected independent law firms and also a sponsor of Startup Bootcamp. Here he is, Matthias. And then the man behind this initiative is Brad Ferber. Brad is American, is a securities lawyer, has done dozens of deals both on the entrepreneur side and on the VC side in the US, and is now an active angel in Europe, based in Copenhagen. Brad Ferber. So I guess, Brad, you're going to introduce the format, but yeah, do you want to do that?
I'll do that. Yeah.
Okay. Are you mic'd up? Okay, here we go. Enjoy.
Work. All right. Well, thank you to all the sponsors, to Alex, to the cast, to Emily, and everyone else. Tonight, I think it's going to be hopefully one of our best term sheet battles ever. It's actually the second time that we've done it here in Berlin. We did one about a year or so ago. And basically the format is pretty simple. We've organized the content into about 10 or 12 key issues. Any term sheet could have as many as 100 issues, but frankly there's 5, 6, 8, 10 key issues that tend to get negotiated. And we're going to break this down. It's an improvised mock negotiation. Everybody on the stage is encouraged to get into the role, be an actor. From time to time, we're going to ask the cast to take their hat off and talk about, how does this really work in the real world? And then it's about a 2-hour program. We're going to organize it into, really, there's 3 areas. There's sort of the I wouldn't call it boilerplate, but sort of the initial issues having to do with no shop clause, that kind of stuff. Then we're going to talk about the economics, and then lastly the control issues. And we're going to take a break about halfway through the program. So in terms of questions and answers, I would encourage you to either tweet them, and we'll write them down, and we'll try and address them at the end. And at the end, we'll have about 10 or 15 minutes where people can ask questions. So hashtag would be just hashtag term sheet battle. And then we'll be tracking that. Okay, so I'm just going to turn it over to the crowd here and let them pretend like, okay, everybody just got seated, has their coffee and water, and this is the beginning of the first face-to-face meeting after the term sheet has been presented.
Hi, Christian.
All right. Hi. Good to see you again.
Well,
So you received the term sheet a
yeah,
couple of days
thank
ago.
you so much. Excited to be here.
Yeah, also excited and finally good we reached this stage. Yeah, I think I would suggest we right away jump into it and go through the major points.
So I guess Matthias and I had a chance to look through the whole term sheet. First of all, thank you so much for having us here. Maybe we can start with a few items on the term sheet, and then we can take it from there. In general, I guess you know the structure of the term sheet. Maybe we can start off first with the valuation. This seems to be the most important thing. I guess the valuation doesn't cut it for us now. At this stage, I would probably just walk away. So just wanted to get your feeling on what you think, why this valuation here, and where you come from.
Well, what we normally do is we compare investment opportunities by thinking about valuations, and what we do is we compare alternatives and see, okay, in the same stage with the same potential, and then we come with this kind of benchmarking we do. We come to this valuation, and same we did in this case for mixed platter, and this is I think. Yeah, this is how we derived to this valuation. It normally and this is already something which we discussed within the partnership, and so this is the way we do it. And normally, if we do a term sheet, that's also something which is I wouldn't say completely approved, although it says here we still have the committee approval outstanding. But again, it's pre-discussed somehow. So is giving your stage where you are now in terms of size of the company, in terms of revenues, in terms of size of your team. I think it is already we pre-discussed somehow. I know you had other ideas, but I think this is where we are as of now. And I think for this we kind of have the pre-approval of our committee.
So, well, in terms of valuation, just, as you know, we've been speaking to a few other funds as well, and there seems to be a lot of interest now. We are getting a lot of interest, so I just wanted to know, I am not comfortable with such a low valuation at this stage. Again, I have to remind you that our technology is unique. With Fruit Platter, we mix 100 types of fruits. Sorry guys. And it's healthy, organic. This whole organic thing is growing in Europe faster than anything. It's patented technology of ours. So the market seems to be wanting organic. We've proven some traction. And I think that common valuations in the US are higher at this stage of the company. So I would prefer to maybe we make a proposal, but at this stage I would be comfortable with a pre-money valuation of somewhere close to 5 million. I think if everyone's done the math, the pre-money right now is close to 3. So I think I think 5 million would make us comfortable where we can say, okay, we agree on valuation and let's move forward to the next steps.
Christian, let me strengthen that point. I mean, I think that there are two issues. First is like what is the pre-money valuation we agree on, and then how it is reflected in the term sheet.
Yeah.
I mean, even if we take the valuation you're proposing here, 3 million, whether we take 3 or 5, we can discuss. But then you are proposing a staggered investment here with 2 installments, and then you also have the option pool, which comes out first. So we're actually talking, if you look at the cap table, this is a huge dilution you're burdening on Nareen here. And frankly, this is like, we have been discussing this with Herbert, I mean, like our angel investor, and he said, no, don't do this at all. So I mean, Nareen is very open, of course, but I think we should first discuss valuation and then how this is put into practice here. So I would propose first maybe a higher valuation, and secondly, it should be a fixed price for the first tranche, and then we can talk maybe about a second tranche, but it has to be at a higher valuation, and you're proposing the same valuation here, and. Thirdly, if we talk about milestones, I mean, we have to talk about who's calling the shots here. So here we have all at your discretion. So I think we have a couple of issues here. I mean, we're very, very happy that we've gotten to this stage. And I mean, you're such a great partner to be. We're really, really happy. Let me also strengthen that. But there are a couple of points on valuation we have to discuss.
Yeah, I think we should distinguish between a couple of points, so we shouldn't mix up too many things, too many other points which will come later here.
Yeah.
But I think it's important in how a bit background on how we get to this valuation. I mean, I tried it out.
Yeah.
It's great. It's good. So
Yeah.
it's tasteful. So it's good. I can only recommend doing this. But on the other hand, there is a competition.
Yeah.
And also tried the others out, and they were also quite good. So there was not too much in terms of difference of the offering in the end. So. Yeah. And I think it's about, and they are also got funding, so the other players here. And I think it's about, and this is why we did not invest in the others or didn't give attention to the others, is because we like the team. Yeah. But on the other hand, we need to really see that there is competition. It's the product differentiation is not that great in the end because they also offer fruit platters in the end, and maybe you can do it a bit fresher, maybe you can differentiate here.
Why would you invest if the product differentiation is not good enough?
Well, because of the team, as I said, because we like the team. We like you as a team. I think the best team will make it in the end. But on the other hand, there's risk associated to that because the others, they are known for really rolling out things quickly. And if you have them as competitors, we also need to do this. Yeah. The good thing is with us as investors, we can help you. We have good support in the US. We have our main fund being in the US, so it's about the US market, and we can obviously help you there much more than in all the other competitors probably. So that's one thing I think, and so that's why I think the team is it that distinguished this, and the product itself, as said, is really about doing the rollout. And coming to your point about the staggering, is you had a good run until now, but for us it's really important to see that this scaling continues, and this scaling means that you need to hire people, that you need to roll this out in other cities. As of today, you are just active in Berlin. This is good. You have the city. It's a land grab thing. So once you're in the market, you have this market. This is good for Berlin, but you need to obviously go to Munich, whatever, and then to Paris, London, and so on. So, and this is the kind of thing where we want to see whether this is possible, because otherwise. Then we wouldn't invest if it's just a play for one city or one country. So that would be very limited, and in this case, probably would be not the case for us. That's why we came up with this staggered approach, saying, well, we want to see that this continues, and that you at least manage to go after at least 1 or 2 more cities, and this is the milestone. And once we are there, we then can see, okay, well, then the story is working. So that's why we came up with this staggered approach.
But you
go ahead. No, I was just going to say maybe I just want to maybe we split up the issues now. The staggered approach is something I definitely want to tackle with you. But to begin with the valuation, today I own 57% of the company. To go down to something like 29, where the VC after this round, this is my first round of investment. After this round, if the VC owns more than me, then in the next round of VCs, I have no idea if I'm going to even run the company after this round. If I fail, you can kick me out because you have more shares than me. So I would say maybe we tackle the valuation first, and just, I'm not comfortable diluting so much so early. So if you were to increase the valuation slightly, we keep that as a base, and then let's maybe discuss the metrics on how the money comes in.
I mean, the dilution also comes from other points. For instance, the ESOP. We didn't discuss about the ESOP. I think that may be a point we should then also cover. We put in a quite high number, but if you have good arguments why we don't need this, it's not just for the sake of having something. It's for the sake of really building the team. I think, as said, it's so important to really get good people on board to make the rollout. I think it's good to have a sizable amount of ESOP. But I think we need to discuss in general, so how you see this and who should get what, and looking forward, and for how long we plan having this ESOP in place, so to say. I mean, because this is a big chunk of in the cap table. I agree with you, and this is also partly obviously diluting here, and obviously also the option. So sure, but this part is also. But I mean, because valuation is one very important point here. I would rather suggest we go through the other points, and if we agree on all others, then we can sort of say just discuss about valuation. And but if we have 10 others, then we should also
prioritize,
and maybe checkmark those or get an agreement on other points which may be also important for you.
Okay, we're going to take a quick break then, and with respect to the tranched proposal, I guess I would put this to you, Matthias. How often do you see that sort of thing in your experience? And then I would ask Christian as well to
well, I mean, if you look at the proposal, it's actually double tranche. I mean, the tricky thing about this proposal is we have two tranches, but also the first tranche, there are two installments. So you're thinking you're getting an original share price, but you don't really know whether you're actually getting that in the end, because as it is worded here, you're getting 25% only if the first milestone is reached. So maybe your original share price, if that milestone should never be reached, is actually a lot lower than what you think you're getting. So this is quite a common thing you might encounter, but we really wary on these proposals. So I would try to definitely avoid a milestone in this scenario. It is quite fair to, as Christian said, to have a two-tranched staggered investment, to have another round agreed on a certain price if a milestone is reached. So that is what we have here on the second tranche. That is quite common. What is tricky here is that the valuation, although the milestone is reached, which is we double the sales and we double the earnings, the valuation stays the same. That is unfair. So the problem is not having a milestone. The problem is valuation on the milestone here. So the valuation needs to be increased on the second milestone. So, but both scenarios are very common, and also to keep in mind milestones. You need to be careful on who calls the shots here. Is it at the discretion of the investor, or is there some kind of mechanism to solve disputes? And also on the second tranche, is that only an option to invest for the investor if this milestone is reached? Is he under an obligation? So those kind of things can be dealt with differently. You see all kinds of things. Usually it's an option from the on the part of the investor.
Okay, and in a world where these startups are, quote, pivoting, I'm curious, Christian, use of milestone at this juncture, what are some of the, what is your experience, and what are some of the lessons learned, perhaps, in a pivoting world?
Well, normally we don't like milestones that much, to be honest. It's really something where we would not, in normal case, we would not propose milestones, because milestones tend to tend to define something which is not relevant in a half a year or three-quarter of a year from now, because you have to pivot. And all businesses we have been investing in the last 15 years, and even the very successful ones, they pivoted I don't know how many times. And so you may define something which leads you in a different direction. You can now say if you have just one investor, it's fine. Because then you can agree on, well, let's change the milestone. It becomes then really complicated if you have more investors involved, because some may think, well, I can use this now to trigger a renegotiation. And other, because they may say, well, maybe I don't want to spend that much money, maybe yeah, or more, or whatever, so to say. This becomes really complicated. We've seen so many cases where it got really difficult when the milestone was not reached, and for good reasons not reached, or one should have gone in another direction, and therefore the milestone skipped the milestone, but we couldn't come to a real good agreement of how to change the milestone. So that's why we really don't like milestones a lot. In some cases, and where we maybe cannot agree on a valuation, in those cases it could make sense to introduce a milestone, and with the trigger of a higher valuation if the milestone is reached. So we've seen this. So in cases where we can't agree on a valuation in the first place, because we say, well, we can't see that much, and if you fulfill your plans, the valuation may be right, but who knows? And we haven't seen a lot of business plans who really have been overachieved, especially in the first phases. So that's why. So I think it's also not unfair if you would then say, okay, well, if you really reach this, or reach whatever 80% of this, what was in the plan, then there may be a bit higher valuation in the second.
How important are business plans for you? We can.
Well, you need something, obviously, but I mean, everybody can play with Excel and produce any kind of numbers. So that's why, obviously, we need to somehow understand, and we need to plan somehow, because we also need to see how the cash needs are, and they develop over time. So there needs to be obviously some look into this is important. But in the end, especially in early phases, we all don't know. So.
No, I was just going to say, also in most settings, again, I played the role of the entrepreneur here. Entrepreneurs focus more so on the valuation, and it's not just the valuation. It's like Matthias brought up, it's the whole package. It's valuation is important, but it's not the only thing. So it's very important to maybe have a discussion with the lawyer before you go to the first negotiation. It is very rare, I would say, that having a lawyer during a negotiation, it's also lawyers cost a lot of money, to have them sit there. My first negotiation took about 8 hours, so you can imagine how much lawyer fee you pay. So it's good to have an initial discussion with the lawyer, and then go to the meeting, just because if you agree, and negotiations, I don't know, Christian, in your experience, but it's not done in a day or in a sitting. It's always you discuss some terms, you go back, you discuss with your lawyer, you discuss with your angel investors and your advisors, you go back and you renegotiate. It's a back and forth approach. But if you're not comfortable with the whole term sheet, and you go in with just valuation, and you say, okay, I agree to this. Let's say Christian says, okay, I give you 3.5 million valuation, but the tranche says, you say, I'm fine with that, then you're pretty much screwed. So just don't agree to anything on the first day itself, because it will come back later and you can't change it.
Also, I think I think it wouldn't, especially in the term sheet phase. I mean, we in most of the cases we are negotiating term sheets. The lawyers are not even involved.
Yeah.
So because it's just costly, obviously. So
yeah.
I won't take away business from you, but in the end, it's really it's about the cost, obviously, and I think because you can also read, you can do those kind of sessions here, obviously, which are good. But you can also research a lot. You find a lot of if you don't know terms, you find a lot of explanations of how they work, what is market standard, and so on. So you find a lot of those stuff in the web. So I think it's something where, but if I would always distinguish between the economical part, because you have to, in the end, negotiate the economical part directly with each other, and only when it really comes to the more legal terms, then, if at all, involve the lawyer. That also saves cost.
Yeah.
Let me get back to the point on numbers and milestones, and what we see and a lot, and what I think is complicated and difficult in that regard, is entrepreneurs tend to be overly optimistic. They're exuberant about their product, and they are exuberant about the prospects, and they tend to present that to investors, obviously, because they want to convince them to invest. And if you put out those numbers, you tend to be held responsible. Then they are maybe transformed into milestones. So be realistic when you put out numbers. Be realistic about your prospects and say, we have a chance, but we don't know. We're confident, but we hope that we can reach those numbers, but we cannot guarantee it, of course.
Yeah, I think that's a very good point.
Okay, we're going to, just in the interest of moving forward,
okay.
that tends to be, in my experience at least, one of the issues that the entrepreneur and founding team is quite interested in negotiation of the so-called pre-money. But there's a lot of other ways that you can carve up the pie. And the next one is liquidation preference. So I'm going to turn it over to Matthias and Naren.
Okay. So, so Christian, I looked at your liquidation preference. Okay, here we go. In general, it was a little shocking to me to see that you have a double dip, and on top of that, you come back to the pie the third time. So, so just, you know, standard liquidation preference is 1x. So you put your money in. I understand that you need to make a return on your investment, but what I've seen in the financial services industry is you standard 1x, you get your money back, and then anything more than that, if you get more than 1x, then, you know, it's just divided equally on the number of shares. So basically, there's two big concerns I have with the liquidation preference. The first one is, apart from assuming that we hit all the milestones, assuming that you're going to put the entire amount you've committed, which is about 1.125 million. So the 750K first tranche, and then the half of that 375K the second tranche. If you put all of this, and let's say I have an exit of 5 million, let's say, at 5 million exit, you're going to take out 2x, so you're going to take out 3.25 million out of it, and then you're going to come back and you're going to take out another, how much is this? 30% from the rest. So that's, you know, out of 1.7 million, you take another 600K. So if I make a 5 million exit and I sweat it out as an entrepreneur, you take 4 million out of that, and that's the first concern I have. The second concern I have is, let's say that I don't have an exit. I'm going to build a very, very strong company, billion-dollar company, however big it is. The next round I raise is going to be a 10 million round. The next investor who comes in from the US is going to say, hey, Christian got a liquidation preference. Why don't I get it? So me as an entrepreneur never gets out of this cycle because you set the first investment and it never goes away for me. So I would just, it's an impossible deal.
The battle begins now.
Yeah.
No, but I mean, we wouldn't be sitting here if you would tell us, well, it's a 5 to 10 million exit company. I mean, we are sitting here because we believe this is a 500 million plus exit.
Yeah.
So this is why we are here.
Okay.
And the only reason, basically, because otherwise we would have never got an approval from our investment board to at all follow up on this one here. So that's why we're here. And if it's in a 500 million investment exit, 500 million plus exit, it doesn't matter in the end for you. So so that's why we believe it's fair. Two times it's fair. Yeah, I mean this is then a couple of millions. You know, it's just, you know, you realize that some money is going in our direction. So a bit
so
more
it's
here.
not. It's
so for us it's really, and this is obviously the one side that we believe all this. Now let's assume everything fails. You know. You have you don't like this business anymore. You don't work, you know, 9 to 5, and you don't like this business anymore. And this is then either a total write-off. Well, then there's anyway we don't need to discuss because then it's nothing. But then, coming back to your point, this is a 5 million exit. I mean, this is for us. It's horrible. This is horrible.
Why?
We have
Out
also
of
investors.
30%,
we have also
you still make 1.8
we have pension
million.
funds in our fund. You know, what they need to earn money for their pensions for the people. So this is really something where we need to earn money on this. And two times is nothing. If we come back to our investor with 2 times, we can never raise a fund again. So we have to earn. We have to deliver 4 to 5 times.
I understand the VC investment thing where you need at least 2x return. So let's
4x,
okay,
4 or 5x at least.
Okay, so 4x of your 1.1 million is you need to make 4 million. So let's put a cap on 10 million. After that, it's equal shares. There's no preferred. And first of all, 4x I'm not comfortable. If you're making 4x on every investment, then public markets will disappear. So in general, if your motivation is that you need to return money to your LPs, then we put a 3x, whatever your return is. Let's say, what is the total amount at which you get this return, and let's cap it there. And we say that this clause does not continue after that. Just because if I make an exit of 50 million, this clause stays. If I return an exit of 500 million, this clause stays. And the other thing I'm really, really worried about is the precedents you set in every future round. Because the next VC who comes in will also ask for this, and the next VC who comes will also ask for this. So I am comfortable overall with the cap, and but we have to agree on what this cap is, and we have to see how it disappears.
Well, I think I don't buy your point that the subsequent investors will also ask for that, because this is obviously the most risky round of financing now.
Absolutely.
So the subsequent rounds have less risk then. And we hopefully be in the situation where we can choose among different investors and can take the best offer.
Christian, seriously, I mean, you know that things are different. I mean, I haven't seen subsequent rounds not asking for liquidation preference in the same amount. Usually, it even comes on top. They want to.
Yeah, but they get their money first. So in the cascade, I mean, they get their. If they then ask for one time, then they get
well,
one time.
if you're comfortable if you're comfortable that the company is going to be successful, and if you're comfortable that the next round will not ask for it, then why don't we put a cap? No. It's a win-win situation.
And Christian, also your point about you having to make money. I mean, sorry, I mean that's the business you're in, and you have, as you're saying, you have many eggs in the basket. You have, I don't know how many investments, probably 20. So, I mean, you can risk losing one. Whereas Nareen, I mean, he has only one. This is his investment. So, I mean, he is dependent on getting some return, and you're taking it away. In that instance, when for whatever reasons this doesn't work, it's still like 5 million. I mean, for him that is a lot of money. For you, I mean.
Well, hold on. After 5 million, I only own 20% of that.
We support building great businesses. So, and we made, I think, in our history, 100 people to millionaires and more. So this is our business. Sure, that's true. And we want that the entrepreneur earns a lot of money. That's why we are also here, because we believe this is a 500 million plus company. And again, in these cases, and this is the case why we invest and how we want to build the company or help building the company together with you. And if this is the goal, we should go after this goal and have this goal in mind. And as said, in this case, it doesn't matter in the end for in terms of
exactly. So the cap should work for you. Yeah. We're aligned in that.
Or we can talk about a cap at a certain whatever 100 plus million.
So
okay, let's take our hats off for a second and just talk about what typically is happening in Series A rounds, say here in Germany, in terms of liquidation preference. And one of the things that I didn't hear tonight, that I did hear last week up in Stockholm, was something called cumulative dividends, and that's another way to kind of stack a liquidation preference into it. But I'm just curious, Christian, what do you typically see in general here in Germany?
Well, typically we see one-time liquidation preference. And we see it not being fully participating. So in the end, sort of it can really decreasing then. So this is what we see, and I think it's the same in the US. So I think it's pretty much the same, and this is pretty much standard.
Yeah, I think we don't see like. I think it is my impression that it's getting worse but I'm not sure.
I
Maybe
agree.
that is.
I agree. Yeah.
I think there's like numbers get up. So it used to be only 1x. It's investors get more demanding. But I can only agree like 1x plus full participation or like maybe reduced participation. But yeah.
And what about in later rounds? I mean, is there merit to the argument that if you create this structure in the Series A round, that the guys in the B or the C round are going to say, oh, yeah, we want that deal too? I mean, what do you see in that regard?
Yeah, I mean, normally you look if it's a one time, I think nobody would argue about this. If it's more than one time, everybody would argue now. So if you see this, so to your point, if somebody comes in and see it 2 times or even more, probably they would ask for restructuring this and then bring it back to 1 and have the cascade then. But this so the previous round just with the 1x. So this is what we see.
Okay. All right.
In general, if you get a term sheet with a liquidation preference, it's very, very easy to do the math. Just put on an Excel spreadsheet the shares that the VC owns and build it out, 5 million, 10 million, 20 million, exit, build it out and see how much you as an entrepreneur makes. Take half of that because that's, you're being generous, and then take another half in taxes, and it's very, very small what's left for you as an entrepreneur. So build it out, see what you're comfortable. It's a very simple 5-minute Excel workshop, so that you know exactly what you make as an entrepreneur at the end of this company.
But and you will definitely encounter the argument Christian put forward. It's very.
It's common. Yeah.
No, at the end, I think one time is somehow fair. I mean, you need to think that if we get the money back, as said, and this is really true, it's a kind of I would say, but it's a write-off for us in the end. So it's something you wouldn't. Well, we always say no money, no time. So in this quote, but in quotes. So it's really something where we say, well, it didn't work, and getting money back is something where we say, okay, well, this is it doesn't move the needle for the fund at all. One must say.
Yeah. And just to go back to that, if you do the math and you say, okay, let's assume the VC's invested $3 million for a 30% stake, and then the company gets sold for $3 million, and let's say it was only 6 months later, if the VCs don't get the liquidation preference, in that case, the VCs just lost $2 million and the founders just made $2 million. So clearly, there's a reason why there's this liquidation preference that exists. But anyway, we're going to move to.
It's also important, I think, what Christian said is of course right. I mean, you have to understand where the VC is coming from. I mean, they are not like if they're trying to impose those clauses on you. I mean, they are not being unfriendly. They are just protecting their interest, and their interest is they are in a very risky business. They actually need to make money, and it's other people's money. It's not Christian's money, and it's not somebody's money to a large extent, at least. It is other people's money. So you're under a fiduciary duty, actually.
And you only get to use it once, right?
Yeah.
So I mean, it's not like this goes back into a pot.
Exactly. Yeah.
So we're going to go to another one that I think a lot of founders. First of all, as I look out in the audience, how many of you consider yourselves to be entrepreneurs? Raise your hand.
Well, can I ask a follow-up question? How many of you were shocked when you saw this term sheet? Okay. Well, it's very, very common. Trust me, this is the average term sheet that I've got a lot of term sheets. So don't worry, it's just part of the game. You will still build good companies.
What about investors in the audience? Raise your hand if you're an angel or other investor. So pretty good crowd because we have the Angels Boot Camp crowd here. So I think some founders are a little surprised to find out that they have to earn their stock more than once. And that gets us to the next subject, which is reverse vesting on founder stock. So again, I'll turn it over to the entrepreneurs.
Really, you want to?
Yeah.
Page 7.
Really, I think with the vesting of the founder stock, I have already put in a year in this company. So I'd like to stay there. I understand all my current managers are already vesting for 3 years. I'd like to stick to the 3 years if you're okay. Everybody has a 1-year cliff. Going forward, all the new managers we can probably agree on as part of the ESOP program. They get 4-year vesting with 1-year cliff, if that's okay. Just because I don't want to lose. First of all, I haven't taken a salary for a year, and the only thing I earned is my equity value. So I'd like to stick to the current vesting schedule we have.
I mean, you are extremely important for the company, and in the end, VC investing is investing in people. So it's not about, because there's this business just started, but if you would leave the company, then our money is lost.
Yeah.
This is how we see it, and this is the reason why we invest in it. As I mentioned earlier, it's really investing in you and the team, because we believe you can make it, and you can accelerate hopefully faster than the competitors. That's why we do this. And for us, it's a huge damage if you would leave. And we think, and this is our experience, that to build a company, well, you can be lucky, you can sell it in a year for $1 billion, but we have seen this, but this doesn't happen too often. So it's really something where we believe it takes 6 to 7 years. This is the average we see to build a company, and our proposal comes from that point that we see you probably being still extremely important even 5 years from now. So we wouldn't propose now for the 5 years, but even in 5 years, I think if somebody would then which would be early in our experience, if then somebody would come and would buy the company, still they would buy the company. The main reason is you and the team. So that's why we believe it's only fair, and it's for us it's more a protection for the company, because it's not that we want these shares back and increase our stakes. We want to take these shares in the case it would happen, and would take these shares and incentivize someone else who could replace you. And this probably wouldn't already be damaged, because, as said, we invest in you and your investment to drive this business. So if you would leave, then we would need to find someone else, and we would also then offer shares of this. And
but he loses. You're proposing that he loses everything.
So far,
there's even a cliff for him. So I mean, if we agree at all to the vesting for, we may talk about the other employees and maybe about Susie, but for Nareen, I think it is completely unreasonable to have a cliff for him. It should be the opposite, that at least a huge chunk of his share should be vested immediately. So that is, I think, a fair solution. Second thing, for the rest, I mean, we need, of course, an accelerated vesting in certain scenarios. And thirdly, also for the, we need to talk about valuation here again. I mean, you have put a very smart clause here that even on the good lever event, we apply the liquidation preference scenario, which is really detrimental to him. I mean, if in a good leaver scenario he leaves after 2 years, I mean, he will be left with nothing. So we have to definitely talk about market value in that scenario. So there are a couple of issues here.
Yeah, it also feels like this is more like a takeover offer, because first of all, you come on top with a bigger percentage of the company than me, and then you can kick me out, and now you own another 30% that you can give it to anyone tomorrow.
Well, for us, it's just a protection of the company. This is how we see this. This is really we want to do the best and to make the company a success. And the worst is if the team, and especially the founder, leaves. So then the biggest damage is there, and then we need to. It's not us being compensated for that. We already then have the damage probably. So we already then would suffer and have to
fair enough. But if, let's say, a scenario where you invest in this company, and tomorrow you decide that I'm not good enough, so you kick me out because you have more equity than me, and I've lost all 30% because I revested to 0 now, and I need a year. You can kick me out after 10 months from now even, and I still won't get anything.
And also, I think, I mean, we see your point, of course. I mean, this is all about Nareen, or to a large extent about Nareen. But even if, part of his shares are vested immediately, there's still a strong incentive on him to stay, because he doesn't want to lose the other part. So it's just about for him. I mean, he only has like these shares. That's all he has. And for him, this is like a killer scenario. It's like a shot on the head compared to a shot on the knee. I mean.
But I don't quite understand, because in the end, it's I mean, if you sort of do this point so strongly, so say getting investing earlier, one could assume, okay, but maybe he thinks about leaving, so and just getting something for this. So this scares me.
Yeah,
so
no, fair enough. I am comfortable.
We can talk about the percentage. I mean.
I'm comfortable about vesting. I think everybody should vest in general, but I don't want to restart from today for all the work I've done already.
But I think it's a perceived restart, because in the end you want to work together with you for the next 5 to 7 years, as mentioned. And for us it's really important. You're the asset here. And if you thinking about, well, if I would leave, I have already 25%.
Yeah, but if I leave now, I only
that may be attractive to you, saying, well, I may think about building up something else which may be more attractive. Then we have given away, so to say, 25% for a non-existing founder anymore.
Well, we have built this company so far, so 25% is the value of what I built.
We would say, if you would leave, it's first of all, it's hard to replace you. It's to find someone else.
It's always hard, yeah.
So it's impossible, I would say. And second is, we have damage. I don't think that someone else will really be able to build this company. As we invested in you, we already have then made an investment or taken an investment decision in something which is not existing anymore. So that's
okay.
Why.
So in the interest of moving through this, I am curious. I guess this might be a question for anyone on the panel. If you've ever seen a situation where an investment round was done, 0 shares were vested at the closing, and then there was a cliff, and somebody was terminated, say, 10 months later, and is deprived of really any economic value. Have you ever seen that happen here in Germany?
No. No, what we see in terms of also, we see what we see is that there is a cliff, and so there is a portion vested, and this vesting is in the range of, we see it between 25 and 50%. So it depends in really of the status of the company and which round we're talking. Now it's an A round, then probably more than 25% would be appropriate. If it's maybe a B round, then the 50% or even 75% would be more appropriate. So we see this at least at 25%.
Yeah, Christian is saying that because he wants to take the scare out of the vesting clause.
Yep.
I mean, I agree. You don't really see like shares getting taken away from founders in the early stage too often. I wouldn't say I haven't seen it, but that doesn't mean that this has no relevance. To the contrary, I think it has a very, very strong like impact on the mindset of founders, and it gives a lot of like blackmail potential to investors. So even if it in the end may not come to like an ugly scenario, doesn't mean that this is an irrelevant clause. I'd really say you negotiate hard, because it's all about like being exerted to pressure in when things get rough, and good lever, bad lever provisions. I mean, they really make a difference, especially if the valuation is also as Christian proposed here. This really can be.
Well, we don't like good, bad. For coming to this point, we don't like bad lever, good lever, because you never can really find out what it was in the end. So that's why we try to avoid this and have no clauses about good or bad lever. For us, it's really, or this point is really about protecting the company. So if, for whatever reason, in the end, the founder is leaving, either because he wants to do something else, or the working relationship does not work anymore, we have a big damage here. For the company has a damage. So the idea is just to protect this. Now it's really, is it 25% or is it 75%? Yeah. So this is what it's about in the end. So this is the range I see, depending a bit on the stage, where there is some protection need from our side.
Yeah. In general, I would say vesting is a very, very good thing. Also because I think most of us are co-founders. We're not single founders. That just means that if you have an argument with your own partner, which can happen a lot of times, it's just good to vest because that person does not walk away with half the company because you had an argument. So vesting is a very good thing. But if you're a bigger shareholder, then it's good to put other ways to counteract this this vesting schedule. So one good way is basically to say, first of all, kill the good liver, bad liver clause. It's ridiculous that you should never accept that. But in general, you can accept other things like I restart vesting, but I vest 25% or whatever I vested before. But for any reason you fire me or I leave, then I vest another 40% or something. That makes them want to keep you rather than because you walk away with 70% of the company and not 25. So it'll force the VCs to work with you rather than try to find an alternative. So there's ways to get around this as well.
Okay, one other issue that I want to address is the so-called acceleration, single trigger, double trigger. In the audience, does anyone, or what percentage of you know what the difference is between a single trigger and a double trigger? Raise your hand. Okay. So if there's an acquisition of the company that everybody rings the bell and says, hooray, we had a liquidity event. And a single trigger would mean that you're accelerating the vesting on 100%. It turns out that the acquiring companies typically want the management team to stick around after the deal, do post-merger integration, and get the full value of the company. And at that point, the question is, how do they motivate the employees to stick around and do that? And with a double trigger, it means that you can use some of that existing stock to motivate the team post-acquisition. So this is really a question for you, Christian. How important is that to your firm? And have you ever seen situations where if you didn't have it, it created a problem in the negotiation of the M&A deal?
Well, I think it's in most of the cases where we sold, the people have been vested, and that may not be for the employees or for the stock option pools, not in any case because they're always being refreshed, so to say. And then it's really about so that there is a vesting then. So this issue doesn't come into play. What we in general see is that's why the issue is not very often there, and what we often see is if that the buyer creates a new kind of incentivization program, and so that is what we see.
Okay, all right. Next up, we're going to talk about the option pool, just the size of the option pool. Which again is an economic issue, it's a pricing issue, mathematical issue. So again, I'll put it back to the entrepreneur team here, and you guys can address it.
I think Noreen has already made the point very clearly, Christian. I mean, of course, I think we agree we need an option pool because incentivizing our employees is instrumental to the success of the company. As you have seen, I mean, we've already promised. Two of the key initial employees 3% each. I think we need a couple of more key employees over the next year or so. But I think a 10% pool would be enough. Don't you think, Noreen?
Yeah, I think 10% is a lot. I don't see any key hires. I already graduated from Boston Fruit Institute. That's a fantastic education from there. So I think all I need is one more VP of sales who can grow this. The technology exists. The market proof is there. So I only see maybe one key hire. That's it. So I think a 10% option pool is more than enough, I would say. And actually, I would also like to use that option pool to reboost myself because you're diluting me so much.
Well, I mean, what we see. Well, first of all, I think we see that I think there is more need for options, especially if you want to accelerate and enter the U.S. market and so on. So I think just these 2 times 3% is 6%.
Yeah.
That's a given somehow because it's already taken, so to say. It's not granted as of now, but
Yeah.
we virtually should take this out. I mean, if it's already promised, so to say, we should. So then we're just talking about 14% in the end,
Yeah.
not 20. And 14, I think, is pretty reasonable for this because we will enter the next phases where we need good
Well,
people.
if I think
and,
that
and in the end, if it's I mean. This is the second point. So I believe we would need this. Now you can challenge it, well, you need this, we don't need half of it or whatever. But in the end, we jointly will decide whether we will grant this or not.
Yep.
So whatever we discuss here, whatever number we discuss here, it's only about what we will then grant. So, and if not granted,
It goes back to the founders?
You don't suffer. You don't have this dilution.
Well, if it's not granted, can it go back to the founders?
It goes back to the company then.
No,
so
but-
it's
but-
basically it's not.
Christian, let me
And
make,
you own 30% of that then.
You too.
but
You too. So you're earning the same.
But
there.
Christian, come on, you're not being honest. I mean, you have calculated your valuation on on the full exercise of the option. So I mean, if what you're saying is correct, I think let's go back to 10%. Let's go back. Let's say 10%. Okay, that goes out of the founder share at the moment.
I don't. Why is it going back of the founder share?
Well, wait, okay, but maybe that could come out of the founder share. But the next, like if you're saying, then if we jointly decide we need more options, then it's as you're saying, then we're in the company together, and why shouldn't that come also out of your share and dilute
Everybody.
Yeah, everybody.
Why don't we do the following? Why don't we agree on, well, the 6% are anyway granted or not promised at least. So
Yeah.
why don't we take them out, so to say, of the equation?
Yeah, but
And
6%
then we
pre,
have
right?
14, and then we reduce the 14 by, yeah.
Well, that's 6% pre. So post would
Then
be.
let's take 10%, so to say, plus the 2 times 3, but which you already promised somehow.
Okay, but can we
So
agree?
we're kind of in the middle there.
Yeah, fair enough. Can we agree on 2 other things? The 10% comes from everybody, not the founders.
No,
And unvested option pool goes back to the founders.
No, I see this as written here as really on the fully diluted. So, but as you said, you have already promised 2 times 3,
Yeah,
3%, 6%. So 6% we need to retake out here, and so they are already there. And so this is why it reduces in the end the additional pool to 14%. And my proposal would be that we don't. I agree with you, maybe a bit too much, so we go down to 10%.
I would agree with 10%, yeah.
So
10%
there would be in this sort of say mechanics, it would be then 16.
10% total pool would be good, I think. First of all, the money you put is
I agree with the 10,
too small to grow in the US.
But
yeah.
6 you have already given away, so.
Yeah. No, I know, but
so they're not free in the sense of really motivating other people because these two poor people, they're expecting this already.
No,
So
fair
they
enough.
get this.
But I'll tell you, the next round of investors who are going to come in will add another option
They
pool.
will like it. They will like it in the next round. If we still have something which is, so to say, not granted, they will
Yeah.
like it. They will say, good, you have an option pool.
Yeah, and they bump it up another 20% because we started it.
Yeah, but then we are also suffering from that. So
No, fair enough, but you put in 1 million that barely allows me to expand to Germany. If I have to go to the US, we raise another round. At that time, we'll add more incentives. This round is purely used, and I don't think we need 10%
yeah, but
equity.
if you want to expand to the US, it makes sense to hire good people in advance, so to say. And for this, you need the grants, and not having the same situation that you already promised something which you can't fulfill.
Did we get agreement?
Yeah, I would agree to this clause, yeah. In general, I believe very strongly that...
Before we move on, I'm just curious, is the expectation that the option pool, is that supposed to take you to the next round, or is it supposed to take you beyond the next round? I mean, what would be typical from a VC's perspective with respect to those options? And why are they really important that you have that in the tool chest?
I've do a couple of questions. I think it is normally it is for a certain period of time, but not longer, obviously, than to the next round. And it's normally we discuss really the next hires. So we have a look at the org chart and say, okay, what are the missing positions here, and how do we need to incentivize them? And then we come up with this, either be it 2 times 3 or 3 times 3, whatever it is, plus for the rest of the team. So that probably, in this case, would be the right size probably would be here 10%, so to say. So to have the people that you have already on board, and then have something, in this case, then the 4% here for additional hires, and maybe one guy, another 2% and 2%, and then you have something for the rest of the team. This is the way how we go after this. Really see, okay, what are the next hires for the next year or so, and then see that we covered this.
Is ESOP common in Germany, where most of the investments here have all early employees have shares?
No, not all, but obviously you need to do some. It's not the whatever second level or VP level or however you call it, so that you need to motivate, but maybe some others. So it's, I think for us it's always good to have a couple of percent to really to give it to maybe salespeople you want to hire, and then so on, so, or 0.5% here, 0.2 here. So that makes a lot of sense.
Yep. It is often a little more difficult to actually implement an ESOP in Germany, due to, like, if you're dealing with a GmbH scenario, or like there are notarization issues and to some extent, and so it's a little more complicated than if you're coming from the US and are used to, this is a very simple thing. And this in some scenarios, I mean, there's always everybody is talking about having a stock option plan to incentivize employees, but actually putting that into place, like, people are lagging behind. So general answer is yes, it is common, but implementation is a little more cumbersome.
Legal fees. Yeah. Legal fees. Okay, we're gonna next talk about anti-dilution. Does everyone in the audience know what raise your hand if you don't know what anti-dilution is. Okay, I'm going to let Matthias explain what anti-dilution is.
Go ahead. Go ahead and explain.
Before we get into this, do you want to explain that?
Well, anti-dilution is trying to protect, or the investors are trying to protect their interest against lower valuations in future rounds. So by anti-dilution formulas, they want to be treated as if, like, if there is a lower valuation in a second round, they want to be treated as if they had invested at the lower valuation. So that is basically what they're trying to do. So they're getting more shares, although they are not investing more money if there is a lower valuation in another round.
In general, I would just say anti-dilution. I mean, if there's a down round, the company's screwed, pretty much. You have to boost it up, and the only thing you can do to incentivize the founders to bring it back up is to give them more shares. If you take away more of the down round, then you might as well write off the investment. I don't see any reason why this clause should even be there.
Well, I mean, for us, it's also kind of protection clause. So if we agree on a valuation, and it as we all don't know whether it was right or not.
That's the business you're in, right?
In the end, we agree on something, and then if it comes then to the next round of financing, we would expect this to be higher, obviously, because you should have built some value from now to then. I think this is what we expect. So if this is not going to happen, two things happened. Either the value was not created. This was due to whatever. I don't believe you will, but whatever, for whatever reason. I think, why should we then be punished? Because we would expect this value to be created then. When we're talking about a down round, so really below the so something has really gone wrong then. So that's why I think it's only fair to treat us then, and we might have also set the valuation wrong, because you are such a great negotiator and you could talk us into the 3 million, so it's you have then, but maybe we were wrong, so to say, because you have been really.
But typically in a down round you write that off, right? You have no more need for being in that company anyway. So why not just incentivize me to give another shot at it?
Well, if it's a down round and we wouldn't participate, you are right. Maybe then, well then maybe there's no round at all.
Okay.
But in the case where we correct the valuation, which we would set now, and you turn out to be the greatest negotiator on earth, and talked us into a really high valuation, and then we can just correct this. And it's the market, and if somebody sees it, it's a kind of double thing in the end. So it's a situation where despite the fact that you had time to build the value, it should have gone up. Now it's gone down. So you could argue there, well, the initial valuation should have even been much lower then. We should correct below the point the new investor would want to. This is not what we're proposing here. We're just proposing to take the same. I would argue we could have also made the proposal of even go below that.
No, but I think there's a fundamental conceptual difference here. I mean, I think Nareen sees the cooperation with you as the beginning of a marriage. I mean, you're starting something together. And I think he wants to be in this with you. And so from the start, when you're in the company, then it is also your baby. Maybe not to the extent as it is Nareen's, but you're sharing the profits. I mean, you get more of the profits than him, but still, you're sharing good and bad. And so, if things go bad, why should you be compensated on Nareen's shoulder? I mean, that I think, if I may talk for you, I mean, you see this as unfair.
No, but this is not. I would see it as unfair if you if someone else, if the market says the valuation is lower than the valuation, we would agree now in a year from now.
For whatever reason, I mean, maybe things have turned out different.
Yeah.
Yeah, but why should our investment be hit by that, so to say?
But why shouldn't Nareen?
Why should mine?
Yeah, because maybe then you have done things not the way you should have been doing things, and
maybe you're making the wrong investments
in the direction, and the reason that we still would be supportive is also, but then at least if we would be still supportive and would continue financing, then at least the valuations should be corrected to the level. I'm not saying below that level, to the level where a new investor would be willing to invest. But this is only fair, because otherwise, why? This is also protection for our investors here, because then they say, well, maybe you didn't negotiate it right in the beginning and tapped into something which is. But
Christian, I mean, we may argue about whether this is fair in general or not, but do you really, you're proposing a full ratchet anti-dilution here? I mean, if that means, I mean, if there is only one share being sold at a later round at a lower value, I mean, you can take that valuation and get like all of your shares. Or more for all of your shares. I mean, that at least is obviously unfair. I mean,
this is a point where I would see where we can come to a solution here. I mean, I'm not so inclined to come to a solution on the valuation part, because this is really kind of fixed, carved in stone. But on this part, I think I would be willing to compromise. So if this is the only point, so to say, left, I would say where we don't agree on this, I would say yes, I would compromise.
Well, we'll come back to this after the discussion on the other.
Okay. In terms of anti-dilution clauses, I sometimes do a little research on what's standard in the U.S. And one of the things is that in the last quarter, I think it was of VC-backed deals, 96% had broad-based anti-dilution, 3% had a full ratchet, and only 1% had no anti-dilution. One might argue, if you think about a full ratchet and how that sounds like a blunt instrument, and really is, you might say, wow, really? Are 3% of the deals out there, do they have a full ratchet? And the answer is yes. And I'm curious, Christian, if you've seen full ratchets used in the deals you've been involved with, and what's that symptomatic of in terms of the disconnect that may be existing between the investors and the company?
Yeah, well, we've seen full ratchet in the past, but it was really more in the past. So nowadays we don't see this anymore. We see weighted average somehow, however you then calculate it, and the formula is. But this is what we see nowadays, and I would
So
say
when
that's also.
when you did see it, was it because the entrepreneurs were just pushing the valuation so hard that the VC's just like, okay, if you say so, but I mean, because isn't that really what that is all about?
Yeah, I think at that point of time where we had that, it was more common, more market standard, so, or more a bit the European way of doing venture. But I think now it's really more similar to how deals are done in the US, and this is what I see as pretty common nowadays.
Is it true that I guess on most companies you've invested in, when it's happened that there's a down round, do you actually use this weighted average and get your shares back, or you push it back into the entrepreneur, or you replace the founders?
That's actually a very good point. So I must really think of a case where we really enforce this clause. So it's so it's a very good point.
So it's one of those things you just for safety,
where you have down rounds, you anyway need to restructure something, and the contracts are being completely renegotiated, and it depends also whether someone else joins or a third-party investor joins, and so on. So, but I really need to very hard think about whether we really enforced this. So it's really you have cases where you have a new setup, maybe a founder left or whatever thing is happening, then you anyway have to restructure it somehow. But then you structure it rather new than bringing this into or enforce this clause. So,
on the same topic, how many contracts are, I guess, fully renegotiated in future rounds, and how many clauses stick for forever for the founders?
How many clauses? I mean, we have. Important clauses are these tag-along and drag-along clauses.
Yeah,
I think
of course
they are quite important, because we saw cases where it was really where normally if you have a buyer, buyers want to buy 100% of the company. So it's really important that you then, in the case everybody is, or the majority is really willing to sell, that you really then can get all the shares and make a deal. Otherwise, you're just blocked somehow. So. This is
We're going to talk about that in the second half.
I know, yeah, but
Okay.
The last thing before we take a break is representations and warranties. And this is where basically the investors are expecting the entrepreneurs to stand behind all of the factual statements that have been made and stand behind it with potentially personal liability. So again, I'll put it back to the panel as to how often, well, I'll let you guys deal with this issue.
So on the representation, representation warranties, I am very happy to represent everything on behalf of the company, but I'm personally not liable for anything, especially intellectual property. I mean, I know there's a patent pending, but who knows, the US government might never give me a patent. So I think we can have the company represent everything except intellectual property. That's just, we have filed for a patent application. Your analyst has asked me 10 million questions on it already. So I think it's fair to just say that the company represents everything and not me personally.
Well, I think there are a couple of. I somehow see your point, but there are also some points where we also would. Would ask for also the personal guarantee here, and this is for a couple of cases. So obviously the ownership of the shares, it's pretty clear.
Yeah,
so
for sure. Yeah,
that's for sure.
Yeah.
But it's also about and we do it the way that we basically want to have a list of all the contracts, so to say. So this is clear, and for those kind of points, we really want also because otherwise you rather put all on the table that we have everything, we've seen everything, and you should then also personally guarantee that you have put everything on the table. So this is something what we really want.
I agree with those two.
And with the patent thing, I agree that nobody knows whether it's going to be granted. So.
Yeah, but Christian, I mean, he's not getting the money. I mean, why should Nareen, as if you give him money, like if you sold or if you bought his shares, I mean, I'd agree he should give personal warranties, but the money goes to the company. So the company is he has the company has the economic benefits of your investment. So other than the shares, I mean,
I can say I own my
share
shares.
ownership. I think this is really tough on Nareen. I mean, maybe there could be a nominal amount, a small amount he is guaranteeing, but this could be a tremendous liability for him. I mean, I can't advise him to subscribe to this.
Well, as said, I mean, it's what we're asking for is just to open books, so to say, to really put everything on the table, and maybe we can come to a solution by reducing this to an amount which is kind of suitable. I mean, we have invested in founders who had a lot of money already made before, so they could guarantee for something, and
most founders are. Haven't had so much
but
money.
it should be
They won't raise, if I've made so much
but
money, I won't raise.
It should be, you're also getting a salary, so it's not
Yeah.
that there's nothing, you know. So and I think some stake here in the respect of, well, it's things. In the end, it's about that we want to know everything, and the only way to ensure this is, because we can't prove, would take much too long if you would, is that you really put everything on the table and say, well, this is it, but there's not more.
Okay, we're going to take a break in a second, but I would, before we do that, the thing that I see in the U.S. is there is actually a big difference between West Coast versus East Coast in terms of founders personally repping and warranting. In the East Coast, it's more common. On the West Coast, it's very uncommon. What I've found by doing these term sheet battles is up in the Nordic region, apparently it's very common. I'm just curious what you see down here in Germany.
Well, the request is very common, of course. It's a matter of negotiation, but I guess you probably won't be able to avoid reps and warranties as a personal reps and warranties as a founder. It's mostly about caps and limitations on those warranties. I think the point I made is it's a valid one about who gets the money. I mean, this is really about who benefits from the investment. But then, well, what Christian is saying, I mean, of course that is a valid point as well.
Well, in general, I would personally say I would never personally warrant anything, because the debt or the liability puts me in such a hole that I can never come back and build another company again. So never, if I don't put everything on the table, that means that the company is not stable anyway, so I'm not making an exit at this stage. That means I'm not making any money out of the company other than my salary. So I would probably say most entrepreneurs are not lying. And if I guess there's just no reason to personally guarantee anything, because my entire future is ruined by a personal guarantee.
No, I totally understood. We don't see this. What we have in most of the cases we have this, but we limit this, and this we do in relation to the yearly salary.
Yeah.
So it's capped somehow, and it's in relation to something which would maybe hurt you, but it wouldn't kill you in the end. So it's something which is, as there is a salary, so we relate this somehow normally to the salary.
Okay.
We're gonna try and wrap this up here in the next 35 minutes. Christian actually has to leave at 8:20. So there's 4 more issues that we're going to talk about. We do want to leave about 10 minutes for Q&A. And since I'm sure some of you want to hear what Christian has to say, what we might do is shut the process down at about 8:10. And that way there's at least 10 minutes of Q&A. So here we go. Next up, we're going to talk about what are really control issues. And sometimes when I introduce this, I think there was the Bruce Springsteen song, you know, poor man wants to be rich, rich man wants to be king. And when you think about, you know, how you carve up, you know, both the economics and control, that's what this is about, is, you know, who gets to decide, and how does it work, and what are the ways that the investors can either influence or control certain decisions. So first up, protective provisions.
Can you guys hear me?
Yes.
Yeah. Okay. Yeah. On the there were a few things that I want to discuss on the protective provisions, Christian.
Okay.
The first one is you don't let me finance the company anymore without your approval. Better?
Yeah.
Okay. So basically, I can't raise any money without your approval. That means that you can easily bleed me dry on finances and then come back and say, now you need more money. Here's a shitty valuation.
But let's go precise to the what point is it really that you I mean.
So basically, if I look at the protective provisions, I cannot amend, alter, or any of the provisions or the articles of association. So that means I don't, maybe from a legal perspective,
right.
I can't issue any additional shares.
Well, not without his consent.
Not without your consent. If I can't issue any additional shares, that means I can't raise any more money without your consent. That means that I am tied to your approval to raise any more money. So that's the first thing.
Let me direct right away to this. But if that would not be the case, you could raise money at any valuation. So to see,
that's good, right?
In our high valuation, and you could do it. So if it would be the other way around.
Well, you have an anti-dilution protection anyway. So I'm only raising an up round. It should only increase the value of your shares. So you should want me to raise more money.
Yeah, I mean,
also it reduces your risk if I bring another VC.
Yeah, but in the end, we need to jointly come to the decision of whether to raise more money and how. So in those cases, I think it's important that we have this right of triggering this in the end and jointly agree on this. But I think our vote is extremely important here.
Let's just leave the ability to finance or issue additional securities to an approval of majority of shares. So it's 51%. I don't know if this is common in Germany. In the US, you have a board, and it's left to the board approval. And any financing, liquidation, or sale of the company is subject to the approval of board. So you have a board seat, and you get to vote on it.
No, but those rights are extremely important for us, especially the sale of the company, because I think we have to. We may not want to sell the company, and maybe not the right point of time to sell the company. So I think
you have your liquidation rates. So I would never sell before you make your money.
Yeah, but it's not about just making the liquidation rates. Is again, this is just for protection of it. Yeah. So this is not that we really, and I think we jointly should agree on whether and when we want to sell the company. So I think this is extremely important for us to have this right to not give this to the majority. I mean, we can talk about the majorities, but in the end, it's for us important that we need to decide on those rights.
I'm very scared that I start raising money, let's say 6 months from now, and you say, well, an investor comes in at a 10 million valuation, you say, well, it's not good enough, I think you need more valuation, the investor walks away, the next one comes in at 11, 12 million valuation, you do the same thing, and then I'm dry of cash, and you come back and say, I think the company is worth 6 million, it's still an up round, and then I'm forced to take this because you blocked 2 financing rounds for me.
But why shouldn't we do this? I mean, we are also interested in a higher valuation. And if
but what is higher is you can block the financing. That's the issue.
Yeah, but in the end, it's really that we jointly sort of say need to come to a point where we say we want to raise more, and there are offers out there, and we jointly should come to this point there. And I don't see your point here that or your why are you scared here? I don't see your point of.
Yeah, but Christian, you're always talking about jointly. I mean. You're talking about jointly, but in the end you're asking for veto rights, which is not jointly, which is only you call the shots. Yep. And also on all the other provisions, I mean, it's not jointly, it's always only the investors. So I mean, of course, in a perfect world we're talking about jointly, but I think this should, in a way, also be reflected in the contractual situation. So far, it isn't. And I mean, let me make another point. I mean, you're you're not only talking about a double dip control here. I mean, you have three main control issues. I mean, you want to be able to appoint an additional managing director. So if things go wrong, you force him to work together with somebody he doesn't want, and you're even forcing him not to be able to sign anything on his own anymore. You have to only be jointly. He's only authorized to jointly represent with the guy you're appointing. You want to install an advisory board where you're also like controlling the not the major shareholding decisions, but the day-to-day operations. I mean, you're really putting a very tight straitjacket on poor Nareen here.
I don't think Matthias even mentioned the monthly financial reporting. On top of that, the milestones I need to hit just to get the money we negotiate today.
But let's go specific to the points you are struggling with. So shall we start with the financing?
Let's talk about three things. First is
financing. I have a good proposal for financing. But for financing, we can maybe agree on something like, if we do a next round of financing, to make it, we should agree maybe on an M&A advisor here, and who helps us. And who drives the
fees
process.
I wouldn't want to pay right now. We're too small a company to.
For the next round of financing, why not?
Well, okay.
And we decide, or we jointly decide then that we go out to a set of whatever.
That's okay for me. We will do it jointly.
50 other VCs, and we take the best offer. I mean, we can do this kind of things. So that we can put this in contract so that you are protected or against us choosing the cheapest guy in town here, and which will dilute us. We also would be diluted, so we would kind of stupid thinking. But in the end, I would agree on this, having this in the contract, that you will be protected, so to say, that we don't force a round at a low valuation.
Or you don't say no ever, if I'm able to finance it externally.
Well, I think we need to agree on the financing. This is, I think, something we really want.
Fair, but you shouldn't say no. I don't see why you should say a no.
Well, if we have, I wouldn't say why. Yeah, I think we have to agree on this, but if we write down here or put in the contract that we jointly initiate the process, and then the outcome of the process will then be the best offer, or whatever it is. We can put this down and take the best offer then.
Okay. Can we then discuss appointment of managing directors? This is where maybe my GmbH skill set is limited, so I'm going to look to you. I am happy to appoint another managing director. It's okay, but I still have control on spending. If I have to ask this other managing director a signature for every 20,000 euro salary I offer, and it's going to be ridiculous. It's, first of all, ignore the bureaucracy and everything. I have no idea if I can work with this person. There's already Susie. I would propose she becomes the managing director, and then we're fine. And so that's the first one. And then the advisory board. I think with the advisory board, I'm happy if you come on my board. I think we can use somebody as strong as yourself. But I would say that it's only you, because if for any reason you quit your fund, I don't want some analysts sitting on my board. No offense to analysts, they're smart, but I'd like to have you. That's why we're working together. And I also want to make sure that we have a third neutral board member that I appoint.
Well, first of all, to the managing director, I agree with you. Let's see how Susie develops and whether she can take this role. Okay. And let's agree maybe on a time where we see and jointly agree on that it's either Susie or someone else. So let's give us half a year or something like that, and then it's either Susie or we then go out hiring someone else. Okay. So that's to this point. I would agree with having me on the board, so to say. So to have me being the representative of us. And I would also be okay so that if you then decide on or we jointly decide on the.
Well, I'd prefer to pick the third board member, just because the next round of VCs will come and ask for another board seat, and I'm immediately lost control.
Well, my experience is that this depends in the end, and I think well, it's not. Well, we also, as you. I mean, it's not you having control in the end. You know, we have to agree on a kind of framework, and I agree with the framework, and to your other points with the spending, as we agreed on the budget. I mean, everything within the budget is agreed upon. Yeah. So it's only the deviations from the budget where we would like to at least get our agreement mandatory.
Okay, I'm gonna cut in here. Maybe, Christian, you could describe the difference in the practical difference between the way the corporate governance works here in Germany with the managing directors and an advisory board, and contrast that to the extent you know with the U.S. method, you know, with the board of directors. I mean, is there a functional difference? Is it just nomenclature, or is in fact there a difference? And I want Matthias to also address the same question.
Yes, there's a big difference. I mean, you can still make it similar in terms of empower the advisory board and give a lot of rights to the advisory board. You can do this. That's possible here. In some cases, we do that. It has advantages and disadvantages. It really depends. So you can normally in Germany it's with the shareholders these rights, but you can delegate parts of it or a lot of it to the advisory board and kind of then be very similar to a typical U.S. board structure. So that's possible. We see
is
both
the
cases.
Advisory board here similar to the board of directors in the U.S.? I mean, because when I hear advisory board in the U.S., it's usually, you know, some guys who provide a little bit of advice, but they don't have any, you know, control, and they don't have any fiduciary duties.
Board of directors, you're right, that's the board of directors.
But the advisory board, is it like the corporate board of directors in terms of fiduciary duties?
You can empower, so you can mimic, so to say, the same, not totally the same, but you can make it very similar to U.S. kind of board structures.
Yeah, but like in a board, like a board of directors in the U.S. scenario, in my understanding, is a little different from a German supervisory board. In Germany, even in a stock corporation, I mean the managing directors, I mean they are the day-to-day operational managers. It's not the supervisory board. They only supervise. They only oversee things. They may have veto rights. They may exercise control, yes, especially in a GmbH, but they don't run the day-to-day operations. So there's no CEO member as a board of directors in a German supervisory board. So the CEO with all the powers you see in the U.S. We don't really have here. It's a little different structure, but still, especially in a GmbH, everything is very flexible. I mean, you can empower the board of the supervisory board with certain things, but it is still different. I think here we have veto rights on the shareholder assembly level and on the supervisory board level. Where you have those doesn't really matter. The important thing for an entrepreneur is he will be asked to grant veto rights to the investor to some extent, and it's always those kind of things. I mean, you can't really avoid that. I mean, with you can try as Nareen has done to limit that and on certain instances, but overall, you will have to live with that.
Okay, we're going to move to the next one. Drag-along rights. Now, Matthias, why don't you just give us in 30 seconds what is a drag-along right?
Well, a drag-along is where somebody wants to sell. Here, the investor wants to sell his shares, and he can force the other shareholders, especially the founders, to co-sale their shares. That makes the exit possible for the investor. So this is a really important provision provision for them, for the founders. They have to be careful because, as it is put here, there's no limit, like the drag along kicks in at any valuation, for example. So you really have to be careful what you're forced into here, possibly.
So without negotiating it, because we want to keep on track, Christian, have you ever actually been involved in the exercise of a drag-along right? And why does your fund, think it's an important provision? Because you did say earlier that you think it is.
Yep, it is quite important, but obviously, if you take the position of, or you as an entrepreneur, obviously you don't want to be in the position that the fund, for whatever reason, comes to the idea to sell already 1 year after and at a very low valuation. So we try to address this by saying, well, let's not have this triggered within the first, let's say, 4 years or 5 years of the investment. So that's our way. There, the entrepreneurs get some protection of not the investor may think, well, let's sell it cheaply now and off to the next. So I think this can be addressed the way. It is important, this drag-along clause, because investors, buyers, in most of the cases want to buy 100% of the shares. So they don't like. They may restructure then the incentive program for the founders or managers staying with the buyer or with the company. But it's very important for most of the buyers to be able to acquire 100% of the shares. And if this is not in place, it can come to a very funny situation. We had that you have maybe shareholders, maybe former founders who have left, or business angels who are still in, who abuse this by saying, well, I don't think it's the right time to sell, but if you offer me double the amount, then I may be willing to sell. So they can really abuse that. I've seen that. That's why I think it's important to have those clauses.
And it's also I can just underscore that it is also important in practice. Like I've seen a lot of, like not a couple of instances where we actually we have to implement that.
And what about in terms of the life of the fund? Maybe you can talk about, a VC fund is typically 10 years with maybe a 2-year extension. Why would these provisions be important for a VC fund in terms of that, in terms of getting liquidity?
I mean, normally it's a marriage, and it's a marriage of time, so to say. And if you somehow think but it can change. An entrepreneur can think maybe, well, I may not think selling ever because it's such a great business. I want to run this for my whole life, and this doesn't match obviously VC investments, because VC investments, as you said, we are managing funds, and these funds have a lifetime. It's 10 years normally, plus 2 years extension, so it's a 12-year time horizon. So in these 12 years, we have to make the investments and also sell the companies within this 12 years to the full extent. And so that's why VC need those kind of rights to also force a sale of the company at a certain point of time. That should be obviously not to damage something, but it should be in the time. And this is why I said typically it's 4 or 5 years, the range where we then can sell the company. But on the other hand, coming to the point whether we enforce this. And we have those clauses to have them, but in the end, we never sold a company against the will of the entrepreneur. This is very clear. So this is impossible, I would say. And so because the buyer, they want to re-incentivize the team and so on. If they say, well, we don't want to be bought, then there's no deal. So that's why it's good to have them, to especially deal with parties who are maybe not so close and not so involved, like business angels or former founders who left. For this, it's really important to have this to make a deal happen for the existing active members of the team. Then, but for us, it's really something where what we need to sell the company at a certain point of time.
Okay, we're going to talk next about right of first refusal and co-sale. I'll turn it back to Noreen and Matthias. Is this a problem?
Sure, yeah. I mean, if I'm okay having a right of first refusal, but you have to buy all the shares that's offered, you can block a sale by offering only half. So let's say that I have 1,000 shares in the company, and there's a buyer for all 1,000 shares, or my shares, and you say, I have the right of first refusal, I'm going to buy 750 of it. This buyer is no longer interested in buying the 250, so I've lost my sale. So I'm happy to have right of first refusal as long as you accept to buy everything offered by the third party.
Yeah, I can only say I can agree on this.
So that was easy. Let me just say...
But maybe one point to this, right of first refusal is extremely dangerous for one reason, because if you have this in the contracts, it's very hard to find in real, if you have a company and you really want to sell this, because it's hard to find a good M&A advisor, because a good M&A advisor will ask, are there right of first refusals? And if they are in place, they say, why should we run the process here and engage ourselves if there are right of first refusals in place? Because then they might not be able to make this a good deal. So that's why I think it's important to not have these right of first refusals. My opinion to this. But I don't know if you share this.
Tag along the co-sale, right? I mean,
That's okay. Yeah.
It is generally okay, but as it is here, I mean, it needs to be pro rata. As it is here, I mean, if if Noreen sells one share, they have the right to sell all their shares, so that will basically prevent Noreen to sell anything. So it needs to be pro rata, and there may be a threshold, but usually you agree on those things.
Mm-hmm. Okay. Before we get off this and move into, well, no, let's just move right into Q&A. So you've only got 5 minutes here. So if anyone wants to ask a question of Christian, stand up now, and he'll be here for another 5 minutes or so. Do we have anyone who wants to? Nothing? What's your favorite beer, Christian?
The big question that I have is, why are you here giving away your trade secrets? Surely part of the benefit you have as an investor, having done 20, 30, however many of these, is that you know everything. So is it in your interest as well for the entrepreneur that you're negotiating with to know everything they're doing? Is that a good thing?
Very good question. I think it's, and that's also why I was very pleased when you asked me to join here. I think it's a very good initiative to run these kind of things. I think it's extremely important, and we have to. I think we're not on par with Silicon Valley here, where the knowledge is much better. I think it's extremely important because if the entrepreneur know what's about, know about the terms, and know about what is a market standard, life is much easier. We much easier come to a deal, and we can do term sheet negotiations in 2 days, and we are done, and we can move on. So that's why I think it's really important also to understand we see our thinking and how we think and why we do this and how we do this, and so that's why I think it's extremely important. And you're saying it's trade secrets. I would say I think it's open. I mean, you have standard term sheets which are standard in the Silicon Valley, which you can take, and there you find everything. So I think it's extremely important to have this very open conversation and also this knowledge building within the entrepreneurial community.
I would add that it's fantastic that Christian does it. Thank you, because I think the fairer the terms are for the entrepreneurs, I think it leads to more exits. It improves the ecosystem here for all of us, and everybody benefits from it. So thank you.
Yeah.
Next question.
Have you encountered Series FF as founder stock, and what would be your move?
Sorry, I didn't get that. Sorry.
Have you encountered Series FF as founder stock?
Edit?
Series FF? Is that what you said?
Yeah. Or you don't know what they are?
a bit.
Okay. It was created by Sean Parker from Founders Fund, so the FF is from Founders Fund. I would not be the best to explain them, but it's for investors to be able to get liquidity in a further round. If there's no exit, or if the exit will take some time, so the founders can get liquidity.
I mean, you mean secondary tranches, so to say. Is this what you mean?
Like in a Series B. So if you're dealing in a Series A, the founders will be able to get liquidity out of the Series.
We've done this, and we see this more often, and especially I think, and it's somehow understandable. So if it's a long journey, so if you do this, in some cases it takes 7, 8, 9 years to build a great company, and especially in the later stages where there's an obvious interest of the entrepreneur to maybe buy a house for the family and those kind of things. I think it's understandable that we should get some liquidity for the founders. So we do this in some cases. It should be somehow in balance to be obviously motivated to get the big chunk of the money, which is still outstanding, in an exit, in a real exit. But we see this, and we've done this. So we've done secondary transactions, and this is, I think, happening more often here, but mainly in later rounds. So I would rather see this in the C and D rounds than in the A and B rounds.
Okay, thank you.
Yeah, it's also called a blended deal, just FYI. Yeah. Other questions?
So I have two quick questions. The first one would be regarding the drag-along. Would you accept a clause where the drag-along would not be triggered by you, but by the board or 50.1% of the total converted shareholders? So that possibly Nareem, if he found something and together with Susie they found something they liked, they could force you into also selling yours? Is that something you would accept, or is it something where you'd say, no, you'd want to be able to veto that or not go along with that sale?
I think it's a bit of a matter of negotiation here. I think for us it would be also the other way around important that this more open drag only happens after a certain period of time, because then we can at least have done, or we can make, or can be sure, but at least we ensure somehow that we did everything to build a certain value. Then you can argue whether you could build more value in another 2 years' time, but at least we built something already then. So I think at that point of stage, I think we are more willing to open that and have this drag more agreed on, or put the decision of the drag more to the majorities, either the shareholders or the board.
And the second quick question would be, you discussed a lot about whether Nareem would be able to finance following rounds without your consent. Would it not be easily solved if you agreed on a certain percentage increase above which you would just accept any further financing? So anything 50 or 100% above what you guys are going to settle on, that you would just accept, so to give him some kind of freedom, some kind of planability?
Well, the practice, if it's a practical, it's more practical. I mean, normally it's never an issue in the end, because you want to raise the next round, and then you talk to other VCs, and then it's happening. Then you take the best offer, not always the best offer in terms of valuation, but the best offer of a combination of offer and fit and so on, value add and so on. So I've never encountered any issues with that regard. So never ever, so to say, in terms of, well, the founder wanted something different than we want.
So in the interest of fairness, because I know you got a hard stop, let's give Christian a round of applause.
Thank you.
On your way off the stage,
Yep.
We've got a present for you. We are going to keep the panel going for another 10 minutes or so. But fantastic job. And again, it was a great question. You know, what's in it for the VCs? You know, how many people in the audience, if given a chance, would love to have a meeting with Christian? Absolutely. I mean, getting the opportunity to meet with venture capitalists, it's hard to get in the door. They look at, you know, what, 2,000 business plans a year? Is that about right? So thank you for sharing with us your time tonight and your expertise. That was fantastic.
We have a poster here, this really cool boxing poster. We've signed it for all the actors. And then I want to plug a book. I didn't write it. I wish I'd written. It's called Venture Deals by Brad Feld. It's actually pretty much the reference on this. I mean, there was a lot of technical stuff. I don't think you know everything that was said. He does a very good job of explaining this in very simple terms. Venture Deals. So you guys are getting a copy too. You probably don't need it now, but you can share it with someone. Thank you again.
Okay.
Thanks for coming back.
Okay, so we're still going to do the Q&A here. Do we have other questions from the audience? Yes, stand up and holler.
Hi, this is a question for the entrepreneur. I would like to know at which point, because what Christian was describing was a business, you know, how to negotiate it. It's a business, it's not emotionally attached to your business. So the question is, how do you deal with detaching from your emotional relationship to your business in order to negotiate on a business? You know, he's planning for 12 years, and maybe you want to die and doing what you're doing, but he's going to sell in 12 years.
Yeah, sure. That's a good question. I think, in general, I would just approach it as an opportunity. Like Brad said, it's very, very difficult to get a meeting with a VC. So it's an opportunity. So take that as, you know, as an opportunity to build your company and to go forward. Without the money, it's very, very hard to build companies today. You can be lucky with goes viral, but it's very hard. Most companies need financing. Where you separate yourself emotionally from the business is mainly because I think you have to recognize that the VC has his or her duties, and that duty is returning money to their LPs. And if you don't recognize this upfront, the negotiation's not going to go well. You're not going to raise money, and it's just, you know, it's not serving you anything. So if you recognize the points that they need to cover, which is sell after 10 years and stuff like that, and you have to give in. There's no choice. I mean, that's their business model. Or you're lucky and you go raise money from a rich individual who's ready to back every single round. Otherwise, you have to deal with this. I don't think there's any way around it.
Yeah, and they're also they're swinging for the fences, right? I mean, I'm not sure if I'm answering, but the VCs really are looking to get a 10x return, and so if you take that kind of money, you should accept the fact that, you know, you need to be driving your business hard to try and achieve that, and ultimately the winners pay for the losers. And the VC business, I should point out, it's a tough business, and it hasn't performed well as an asset class over the last 10 years or so. So, you know, here in Europe, I think more companies, I heard Christian speak about a month or so ago, more companies should hold out and try and get to $500 million or $1 billion so that Europe can be on the buy side of some of these instead of always, you know, typically on the sell side. And that benefits the European venture capital ecosystem, because then those VC funds can go back out and raise more money and finance more ventures. But before we go, any other questions from the crowd? And then there's a couple of points that I wanted to cover if there's not. One is, okay, can you stand up and...
I've just heard that you basically raised $4 million. So how much work, like in terms of time, does it actually take? Like preparation time?
Yeah, it always depends. And again, I have to say that, so for me, it took about 3 months roughly, 3.5 months. A few surprising things is that this term sheet is, I don't know, 10 pages or something long. Typical term sheets should be no longer than 1 or 2, maybe 3 pages. The goal of the term sheet is to come to agreement that you are going to work together with the VC, and then most of these things come back in the contract. You can get around most of these things, but you just want to be comfortable under basic terms. So, and the second good thing to do always is to have a very good balance of supply-demand. I hope that most of you can create a balance where you have at least 1 or 2 or 3 VCs, so that you create a balance of demand. Otherwise, the VC is too powerful. So in general, it's very, very important. It's not just that you're able to raise money in 3 months. It's to make sure that the money is smart money, the money comes from good VCs, and there is a balance of power. Because, like it came up again and again, you're in it for the next 8 years, or like someone else said, until you die. So you better be comfortable with the other person who's on the table.
Yeah, I can.
Yeah, there was an interesting clause, best buddy clause. It sounded strange to me. Could you just explain what that does and why it's there, and who's benefiting from it?
Well, I mean, it is the wording may be a little strange, but the essence of it is that there is a monthly payment for obscure services asked by the investor. I think a VC may not really ask for that, but or like a VC like early bird, they probably not ask for that. But some smaller institutional investors they ask for that, and it's just like a fee for being part of the team. So you will not get any services really for that. You will just have to pay a monthly fee. So it's like a fixed dividend you have to pay. So try to avoid that.
I haven't seen that much in the USA.
Yeah, but I mean, I can tell you at least 3.
If you can zoom in the camera here.
I can tell you at least 3 investors in the Berlin area who do that.
Okay, so I'm going to take a counterpoint to what Noreen just said regarding what's typical with a term sheet. The question is, why do we need a term sheet at all? Why not just go straight into negotiating the contracts? And what the term sheet is, it's the table of contents, and the more issues, in my experience, that you can address in the term sheet, the easier it is and the less expensive it is for the lawyers to document the deal. At least in the United States, these are, when it's all said and done, the various agreements can be up to 80, 90 pages. And if you have a one-page term sheet, you certainly are not addressing all of the issues that will appear within those 80 or 90 pages. If you have a longer form term sheet, then basically the lawyers don't have a whole lot of flexibility or creativity with respect to how to deal with all those other issues. So in my experience, that's why having a term sheet is you can get a true meeting of the minds. With a shorter term sheet, if you miss those issues, you could find yourself several weeks down the line realizing that you really don't have a deal. I'm curious, Matthias, what you see.
I mean, the difficult thing about a term sheet is, I mean, it is theoretically non-binding, or there are only some binding provisions. But of course, in practice, it is very, very binding. This is it. I mean, you will never get off the terms you have agreed in a term sheet. I mean, you will get off the deal. You'll be able to walk away and don't conclude with early bird, but with somebody else if you have somebody. But with early bird, this is it. Even if there is non-binding written all over it, this is factually binding. So in the end, you will probably have to involve a lawyer even negotiating this, because the risk is that you're giving away too much, although it is supposed to be non-binding. But what usually happens, I mean, this is in a way, this was an untrue situation, because a situation where we have a lawyer on the, like myself, supporting Noreen, and there's only the VC having no lawyer. This is not what happens. I mean, you have 2 scenarios. Either there's only Noreen and Christian, that's what usually happens, or there's no lawyer on Noreen's side, but the VC says, okay, this is our standard term sheet, this is how we always do it, you don't really need your own lawyer, like we always have X, and if you have questions, just ask him. So that is really difficult and complicated. So be aware. I'm not just really saying, I'm not only saying that out of individual selfish interest, but it is really out of Narine's interest.
I'm going to throw in one more thing. It's also clearly not the case that you can just go, for example, and use the Brad Feld book and assume that it will work in Germany. It won't. You got to have local counsel, because we're dealing with, in this case, German corporate law, and so it's not that you can just download these forms from the Silicon Valley and assume that they will in fact work in Germany, because they won't, right?
Yeah, true.
Yeah. Anything else?
I would just say it's very, very rare that you have a lawyer. I can feel much more confident here with my lawyer sitting next to me. It's almost, trust me, please get a lawyer. It's almost impossible that you have a lawyer. This is much, much more difficult when you negotiate with VCs. It's much more stressful, because as an entrepreneur, you've put your heart and soul into the company, and the first time you see the term sheet like this, it takes everything out of you. So really, I think that it's easier on stage, I have to say. In the real life, it's more difficult. So take counsel. It's very, very useful. And raise money from smart people.
And be like one thing I like of true advice is like be not too optimistic. Be honest. Be frank. Also be humble. I mean, we always like one thing I often see is people try to like play a role they can't fulfill. They try to be to play a bigger, like they try to pretend they understand everything that's in the term sheet. They try to like play as if they were on a level field with Christian. They aren't. They may be as smart, but usually entrepreneurs are younger and they are less experienced in this type of scenario, and that is a big advantage for Christian. He knows that, and he's gonna play that that very well, and in the end to his big benefit, and possibly to Narine's detrimental interest.
Okay, then the last thing that I guess I'll maybe ask the crowd is, who here thinks that tonight's deal was a Series A round versus something other than a Series A round? I mean, raise your hand, I guess, if you thought this term sheet reflected, true seed round investment terms, or whether it was Series A terms. Do you understand the question? I'm not. Yeah. Raise your hand if you thought tonight's deal was more like a seed deal or more like a Series A deal. Raise your hand if you think seed. Raise your hand if you thought it was more like a Series A. Yeah. And I guess the question is, what's the difference? And in my experience, I think seed round is really, defined as the first outside round by a professional investor, typically less than $2.5 million US, or whatever.
We raised 4 million seed.
So, okay. So you consider your round a seed deal, even though it's 4 million?
Yeah, I guess my definition of seed is mainly if it's the company's launched and live, versus if the company is still building a product or a prototype. Again, it's just a definition. So
let me also one point here. I think be suspicious when it comes to like this is standard, or this is an A round or a seed round or whatever. Don't care about those qualifications or categorizations. It's always like a special deal, and it's always about negotiating, and there's always it depends on the individual power, the power set. Everything is negotiable. Everything. So it's always a special individual deal. That is important.
Okay, Alex, did you want to say anything? We're good. Thank you. Do we want to say anything about what's happening afterwards? How long we have to drink a beer? Or? So I would encourage everyone to do that. I mean, why not exchange business cards, have a beer, and if anyone, to the extent the cast is willing to hang out a bit further, you can address your questions directly. So thank you for coming tonight on a Friday night. I'm amazed that people are interested in coming and listening to 2 hours of negotiating a contract on Friday night, but I hope you all got something out of it. We will be doing a survey. It'll come through Eventbrite, and then hopefully we'll be able to make these videos available for viewing within some reasonable period of time. All right? So thanks. Bye.